Thank you for joining us for this afternoon session. I'm not sure if who of you were able to, who were part of our media briefing earlier. If you are still with us, thank you for staying and unpacking more of the detail. For those of you that have just joined, I can attest that we've already had some dipping into some extremely interesting findings and results, and I expect that this afternoon session will continue to unpack our FSCA's 2020 baseline survey on financial literacy. So after the presentation, as indicated, we will have a panel of experts unpacking some elements of the survey, and we'll also provide an opportunity for you to give comments and inputs during the session. So very much we encourage active participation, ask the questions, help us to unpack the findings and interpret the results to see what can we learn, how can we be doing our jobs as the FSCA in particular better. So how can we be better understanding our South Africans, our consumers, in order to be delivering better products, better financial services, and perhaps a more targeted education strategy and approach as well. So the FSCA commissioned the 2020 baseline survey on financial literacy to examine the financial knowledge, attitudes, and behaviors of adult South Africans as part of ongoing efforts to better understand, monitor, and promote financial literacy in our country. The first survey was reported on in 2012, with subsequent rounds in 2013, 2015, 2017, and now in 2020. The series of surveys is intended on a dynamic basis, and in other words, over time, to be able to identify trends in consumer behavior. So it's not just about where we are at now, it's how these patterns or these observations are changing over time. And this is really important to help us as the regulator, as policymakers, whether if you're talking about the National Treasury Basels here, but indeed anyone who is an active stakeholder in the financial education space, to see what is working, what isn't working, and how can we be doing things better. So the results of the 2020 baseline survey were broken up into 10 themed briefing reports, which will be discussed in more depth this afternoon. These, and I'm not going to read the detailed names, they are quite long. I'll just give a brief allusion to what each one covers. One is an overview of financial literacy in South Africa. We consider South Africans under duress, particularly during this COVID time, and where do we go to from post-COVID. Materialistic values in South Africa, our belief structures and how this is shaping our decisions. Are we financially resilient? Financial resilience is really an increasing focus of the Financial Sector Conduct Authority. How do we make sure that our people are financially resilient and can support themselves and their families going forward? Preparedness for a rainy day, a focus on the banking sector. How do we see banks and banking transactions? Putting consumers first, customer centricity. How do we as South Africans actually see our financial institutions? The generational divide, to what extent does our age reflect our interactions with the financial sector? And of course, understanding how these different cohorts interface with the financial sector is again a really critical indicator for us as the Financial Sector Conduct Authority to understand how we can target and focus our interventions. How do we focus to help those areas that need us most, and what do we do? So whether it's young people versus the elderly, There's often gender differences, whether we are living in rural, urban populations, and the likes. The proliferation of financial scams comes under focus. I'm sorry, I'm preempting things here to say one of the statistics which just really astounded me is that only 4 in 10 South Africans reported that they understood what a pyramid scheme is. And I say this because these kinds of schemes and scams are something that us as the FSCA, we are confronted with continually, these promises of grand investments which just aren't forthcoming. And then lastly, the black tax and how we participate, and our attitude towards intra-family support, and how this may be changing over time. So as you can see, there is some really deep work here and a lot to unpack. So thank you very much for joining us. I can assure you this is going to be a very exciting and dynamic session. And thank you to the panel members for joining us. And please, as I said before, do participate, do ask your questions, give your views, because this is also how we learn and develop. Thank you very much.
Kathy, thank you very much for that introduction for the session today. And I think financial literacy is a way for consumer protection, but also a more financially literate consumer can make better decisions and help lift South Africans as a nation. My name is David Kopp. I'm the head of policy and engagement at the Financial Planning Institute. And I've got the pleasure today to moderate a panel of experts to help me unpack the study. So we've got Mr. Lyndwell Clark, who's the head of consumer education at the Financial Sector Conduct Authority, Mr. Basil Maseko, hello Lyndwell, Director of Savings in the Financial Investments and Saving Unit at National Treasury, and Mr. Kulukani Matea, General Senior Manager of Financial Inclusion at the Banking Association of South Africa. I think what this shows is that financial education and literacy is a collaborative effort. And this study can provide a variety of stakeholders valuable insights into how to design and implement financial education programs that will help deliver better outcomes for South Africans. So the fourth member of our panel, which is Dr. Benjamin Roberts, who's the Acting Strategic Lead and Research Director at the Human Sciences Research Council, is first off going to take us through a presentation to unpack some of that, and after that we'll lead into the panel discussion. So Dr. Roberts, over to you, and you've got the mic. So. Sorry, we can't hear you.
David, can you hear me now?
Yes, thank you very much.
Great, thank you. Sorry about that, and thanks for the opportunity to be here to give you a sort of overview of some of the findings that have come out of the surveying work jointly with the FSCA. Just to say that, it's very difficult in a short space of time to do full justice to the scope of statistics we've collected and engaged with. So it's more just a sort of tantalizing overview of some findings, and we do encourage you to please look online for the fuller briefing reports as well as the in-depth analytical report. David, can I just check that it's displaying correctly? I had a problem in the last session.
It is displaying, and we can see your slide in presentation mode. Thank you.
Great, thank you very much. So in terms of this round of surveying that we've done with the FSCA, and as was indicated by Catherine, there's been a long-standing partnership dating back to 2010 around this research. It's really to understand different levels of financial capability in South Africa by looking at composite measures of knowledge, of attitudes and behavior in the financial space. It's also to, because we've been looking periodically over time, it's really to unpack some of the emerging trends that are happening and look at particular issues related to existing and new and emerging vulnerabilities. And it's also about looking at a strong conceptually grounded approach and framework to looking at themes of this nature. And ultimately with trying to have a set of strategies and policies which are consumer first and also are fundamentally evidence driven. So I won't dwell on this methodology too much. We can always return to that in the Q&A. Just to say it is a nationally representative survey administered as part of the HSRC South African Social Attitude Survey series. And the realized sample in the latest round of surveying was just shy of 2,700 adult respondents, 16 years and older. We did face-to-face interviewing despite the complexities of the COVID-19 regulations at the stage. So it did mean, going to the last point on the slide, that there was an initial round of surveying pre-national lockdown. About a third of our surveying was done during that phase. And then once we got ethical permission to resume, towards the latter quarter of 2020, we resumed and completed the last 2/3 of interviewing. So we're going to cast a little spotlight on 5 particular themes from the broader set of evidence that we've collected. The first one is the overall trends around financial literacy in the country. And what we've found here is, just to say again, it's re-emphasizing the strong multi-dimensional framework that we've adopted jointly with the IEC as well as its global partners at the OECD's International Network on Financial Education. And really, the fundamental understanding of what is this financial literacy concept is it's a combination of awareness, knowledge, skills, attitude, and behaviors that an individual would need to make sound financial choices and ultimately to achieve individual financial well-being. So we have applied this multi-dimensional approach, drawing particularly on 4 core elements. So it's day-to-day money management, medium to longer term financial planning, the appropriate choice of financial products, as well as knowledge and financial knowledge and understanding. So this is a very, very high level snapshot of what we've seen from 2012 to 2020 with our survey series, looking across those 4 key dimensions that I just referred to. And then also on the bottom line is the overall financial literacy score that's been developed, where we combine all those different constituent elements into a single number. You can see the different sub-elements on the indicators on the final column that go into these different dimensions. So if you look very briefly at each one, we see on financial control, it was fairly stable for the better part of the decade. And then we saw a slight downturn, particularly post-2017, as we headed towards the onset of and experience of the COVID pandemic and the associated lockdown protocols. So I'll return in a minute to what particularly is changing within each of those constituent elements. On the financial planning, just to say again, these are all from a 0 to 100 score. So you can see they're all sort of middling or slightly above average. Financial planning was fairly consistent over time. Could argue there's a slight dip again post 2015, but generally fairly stable over the 2013 to 2020 period. The appropriate product choices that individuals make, it was fairly stable in 2012 to 2015 and then showed signs of slow progressive downturn. And lastly, on financial knowledge, we saw that there has, it was in the sort of upper 50s, it swung up slightly to 60, but since then we've seen a slight reversal, quite a sharp one in 2020 relative to the previous rounds. So that's something we can return to in a bit later on and certainly in the Q&A. Taking it all together, what do we find? So we can see that South Africans have very middling levels of financial literacy. So there's certainly, in terms of what needs to be done, there's still quite a bit to promote a stronger ethic and behavioral follow through on financial literacy, financial competencies in the country. So I've color coded this, but this really shows on each of those indicators that I talked to in those different domains, what's happened. So red obviously means there's been a downturn. The yellowish color is more static, and the green means some sense of improvement. So within the day-to-day financial management or financial control dimension, we can see that people's involvement in day-to-day money management is improving steadily over time. But we can see for three of the other indicators, there has been some element of a reversal. The existence of household budgets has been through a particularly sharp decline post-2015. From a sort of attitudinal perspective, a sort of careful approach to one's personal finances has shown some element of a decline, as has indeed the preference for saving over spending. And we might argue that some of those are informed by macroeconomic as well as microeconomic contextual factors. And that's something we can deliberate on too. The only more stable one is the ability to make ends meet, but it's not at a healthy level. So quite a significant share of the adult public is still battling to get by on a month-by-month basis. On financial planning, we see that for most of the indicators, they've been more stable. Not necessarily at a healthy level. So the example of emergency or rainy day funds, the second bullet there, that while it's been fairly stable, quite a large share do not have emergency or rainy day funds in place. And then the top one is the one that's seen a bit of a reversal, where we're seeing the attempts to achieve long-term financial goals. So increasingly, people are prioritizing short-term survival over longer-term provisioning, which again might be necessitated by the economic situations people face on a day-to-day basis. On the last two dimensions, we see on appropriate product choice, we can see that levels of awareness have dipped slightly post 2015. Product holding, holding of different types of products has steadily been going up during the decade. But the other two, thoroughly researching choices and the absence of regret, have all been going through reversal. So increasingly, we're finding people are not making really doing active research before they make a product choice, and increasingly we're seeing signs that they express regret about the choices they are indeed making. So not good news on that dimension. And the last one is knowledge. This one is administered in the form of a knowledge quiz. So we ask people to do some mental arithmetic, and basically we ask basic division, and was steady until 2017, but for some reason has been through a sharp decline in 2020. Knowledge of inflation rates has been more U-curved, and we've seen quite a distinct increase in 2020, but from a relatively low base. And the other three, interest calculations, working out interest on deposits, compound interest, we're seeing clear signs of decline again. So the knowledge as a whole has been declining because of these pull-down effects. This brings us to our second theme, and that's more focusing on the times of COVID and particularly the economic duress that has brought around in the lives of many. So we asked, particularly coming back to Catherine's earlier welcoming remarks, what's going on in terms of people's own self-evaluation of financial well-being. And what we see, and these are looking particularly for the 2/3 that were interviewed post national lockdown. We see that 49% expressed discontent with their current financial situation, 45% said their monthly income was inadequate for their needs, and only 1/3 said that they lived in households with a regular and predictable source of income. So that is something that we have to worry intensely about, particularly now as we're in a high inflationary period. On consumption inadequacies, so reinforcing this picture, is that we found that many households suffered from consumption inadequacies in relation to basic necessities following the hard lockdown period. Slightly over 1/3, 36%, said that they lived in food-deprived households. We read a lot, particularly during the first year, about the rising food insecurity and the attempts to roll out food programs to meet that need. between a fifth and a third, so between 20 and low 30% range of adults interviewed post-lockdown said that they lacked adequate access to one or more of other basic needs, and that included aspects such as household services, clothing, transportation, and so on. So again, we can see the signs of strain on individuals in society as the lockdown kicked in. Outlook is relatively pessimistic in character. We found that 69% expected that the household financial situation would not improve in the medium term. But surprisingly, the youth, despite the high youth unemployment rates they face, tended to voice a little more optimism than older South Africans, especially amongst young men relative to young women. In terms of changes over time, particularly pre-pandemic to during the pandemic, we found that 20% of adults said their lives had improved. Half said that it had stayed about the same, and 27% said that they had suffered a particular financial reversal and that their lives had worsened over the past 2 years. This was particularly true of poorer citizens, pensioners, and Black African youth. The reasons underlying this worsening, around 50% said that it was due to loss of employment or reduced working hours. Just over a tenth also reported an unexpected large increase in the cost of basic household items such as food. So I think this is something that we need to, particularly that point, is one we really need to worry a lot about now, because unforeseen price shocks can really hit households very hard. And I think we're seeing it in the kind of the kind of protests which are emerging around this, and sort of increasing activism around it. We also see that a significant share referred to death, serious illness in the family and household, and this had weakened the financial situation. In our previous session before this one, we talked a lot about mental well-being. And certainly from some of the surveying we've done during the pandemic times, we've found that there has been a sizable share that report mental health challenges within household contexts. Turning to the more positive, the reasons for improved, almost the converse. Dominant factor there is obviously a change in the work situation as well as gaining employment. So that's particularly common to young adults. Excuse me. But not to overlook the contributory role of social grants as helping to provide the social safety net that's required during times of real duress. So that's something that we might want to talk about later, about those, particularly the COVID grants and that rollout and the top-up value on other grants. And then lastly, on this theme, we saw that there was experience of income shortfalls to just shy of 50%. Who said that they had experienced a situation where their income didn't quite cover their living costs in the year prior to being interviewed. And these experiences were particularly common amongst unemployed adults, as well as, again, amongst those of pensionable age, particularly female pensioners. Indebtedness is a particular challenge, with 57% of adults admitting that they went into debt during the hard lockdown period. 22% said that they frequently went into debt during this time. And we saw, again, a clear gender divide running through these statistics. Urban women, particularly those based in metro areas, were far more likely to go into debt during the lockdown period than male counterparts. In the rural setting, we found that men were more likely to go in debt during the lockdown period than those in urban areas. And on savings, although it looks quite rosy if you look at the statistics on the bottom right-hand side of the graph, we see that just over 70% say that they saved some money during the last year. If we dig a little deeper, we see that 18% said that they did so rarely, and a further 28% said they only did so sometimes. So the reality is, in terms of active saving, that 28% that didn't save is probably a bit bigger, because the quite large shares, although they're trying actively to put some money aside, they're rarely able to, in practice, do so. So this brings us to the theme about promoting resilience, which is obviously a core aspect of the FSCA's mandate. The one thing is that I want to just reflect on here briefly is issues about debt burdens. We talked before about indebtedness, and we see that a fifth of the adult public said that they have too much debt at the present time. Just over half said that they owed money to someone. About a fifth said that of the indebted subcomponent of the public said that they felt that that the day-to-day burdens of servicing their loans was proving particularly difficult. And then we also found that about a third of this indebted subpopulation were worried a lot about the burdens caused by the loan. So quite a bit of debt-related anxiety that's present. So looking at the ability to make ends meet, we were a bit surprised by this finding that the 43% on the 2020 figure on the left-hand side was not higher. There hadn't been like a significant surge in the inability to cover living costs. So that might be that it's a bit of a lag effect. So we might, if we were to survey today, we'd probably see that that's ratcheted upwards. For those that in 2020 did experience income shortfalls, what did they do? The dominant response was belt tightening, just simply try and live with less and do without. Secondly, was to lean on social networks, particularly family networks, to borrow food or money just to help get by. Others drew money out of savings and transfers, worked overtime and so on. So we can see that it tapers off quite quickly there. But if we were to cluster them, what we see is those that adopt more healthy strategies, so not going into debt in particular, things that might have a sort of medium to longer term effect on the financial situation of the household. We can see that just over half are trying to engage in just making do without certain types of spending, and if possible, trying to get a bit of overtime work. More negatively, we see that around about a third are relying on forms of borrowing and more unsustainable forms in response to income shortfalls. So that is some element of concern deriving from those statistics. Moving towards the sort of medium-term provision, or particularly provisioning for emergency situations in households, this is the thing that perhaps is of real concern. I mean, we've heard time and again from Treasury and others stakeholders about how we're not a nation of savers. This is a reflection of that. So we can see that 71% at the time of our surveying reported having no emergency funds in place, with only 26% having some form of emergency funds. That picture hasn't remained fairly static, so we're not seeing any real signs of improvement over time to this measure. So it is some element of concern because we are seeing more and more kinds of shocks happen, whether it's climatic, whether it's economic. Households and individuals do need some kind of emergency funds to draw on for these kind of cases. So that it's certainly not there to a significant degree yet. In terms of sourcing, where people source their emergency funds from, the one thing I wanted to primarily emphasize with this graph was the far left-hand side bars, asking family members to help. And here we're comparing the dark blue bars for 2011 versus 2020. And what we're seeing here is there's been a discernible downturn from 46 down to 32% who are relying on family members. We are a nation of social givers, and there's been a range of surveying evidence that's attested to that. And we do tend to draw on our family resources when we need to. But the increasing concern coming through from this figure is whether those social networks, familial resources are being exhausted, given the sort of rolling economic and other crises that have occurred in recent years. So it is something to watch out for. It's still quite strongly present. It's the second most referred to source of emergency funding still, but it is quite an appreciable decline. So the dominant response in 2020 is now using up one's existing financial savings. So that's something just I thought was quite interesting from the findings. Now, turning to topic 4 of our 5 topics is around the banking sector. So we looked particularly at public attitudes towards banking and different banking transactions. So I just want to highlight 1 or 2 points about the results from this section. Firstly, on this one is the public preference for different forms of banking, different ways of doing banking from our surveying. We can see that the dominant response in the green on the far left-hand side nationally is 41% saying that they still prefer to go and bank through the ATM. So go in person, draw, do the actions at the ATM. A small additional share, 16% in the blue, say that they like to visit the local branch. Online banking was only expressed by 16% as a preferred way of doing banking. And then we can see that still quite a big share that remain unbanked or are finding it difficult to choose from the options provided. We've looked particularly at urban-rural distinctions and especially age distinctions within urban and rural residents. And what we can see is the ATM remains, what we can see there clearly is amongst urbanites. Well, firstly, that the ATM is really there, but we do see a greater preference to some degree for online banking, but it doesn't offset the preference for using the ATM. That's quite starkly there. But there are subtle differences between age groups. If one compares the rural urban, we can particularly see the big challenge amongst the unbanked, particularly at both ends of the age spectrum in rural areas. Quite a big large share of youth are unbanked, quite a big share of rural pensioners are unbanked. So that is some source of still concern. And we can see if we are to go the digital route, the whole issue about digital inclusion and digital forms of banking, we can see that there's still a long way to go to change that picture. Then we asked also about views on banking prices and its bearing on behavior. And the left-hand graph really shows the views around banking charges, and we compared those with no formal bank accounts to those with formal bank accounts. And we can there really was quite a stark difference there. So those who have no formal banks, obviously they can't really rate it, but some did try and say about a fifth there said that it was too high. But those that are banked, those with formal bank accounts, we see that it's close to 60% say the banking fees are either too high or much too high. Does it matter? The right-hand graph says yes. So for those that believe banking prices are too high, almost a third said that in the last 5 years they changed their banks because of this. And it's quite a stark difference to those who felt the banking fees were not too high. So you can see it's the difference between 31 and 10%. So real big behavioral bearing that views around banking prices has on banking choices. Online banking, we've looked at it on the left-hand side. So 33% say they've never banked in any online format. Further 17% said they've rarely done it nationally. 25% sometimes, and 23% said they've done it often or very often. Obviously, that is linked to one's online presence, and that's why we've looked at the 4 right-hand bars and you can see that there is an increasing tendency based on the degree to which one's online, and it gets quite strong at the far end. For those that are online more than 6 hours a day, have had a far greater tendency to have engaged in some form of online banking. So it really is about digital access. I mean, obviously we can have long discussions about data pricing and so on, but I think it is really, if we are to promote digital inclusion, we really need to think about the ability to get more people online at a cheaper price. So the last topic is really a hard look from the public perspective at financial institutions. So what we did here is we adopted the Batupili or people first principles, and we asked the public to what extent they felt financial institutions lived up to the spirit of each of the Batupili or people first principles. So this is the summary. It's ranked highest to lowest based on the green. What we can see is people are quite positive about getting good information. They're quite, but you could argue it needs to be beyond 45. It would be nice if it was up in the 60 range, but you can see there's on most of the green bars, it's in the 39 to 47 range. So not a particularly positive, overwhelmingly positive appraisal. So more circumspect. The one that they're little particularly harsh on is issues about consulting. So consultation, engaging with the financial institutions is something that they particularly strongly feel there could be more of. I won't dwell on this one. This just gives a sense of the social demographic variance underlying these evaluations, and there really are quite strongly unequal voices in these appraisals. It increases more positively based on level of education. So the tertiary educated are far more positive on 7 of the 9 indicators relative to those with lower levels. We find white South Africans are particularly critical overall, pertaining to aspects such as courtesy, redress, and value for money. And spatially, we also find quite strong gradients there with Limpopo and KZN. So more rural provinces tending to voice in some instances, a far more critical stance on the conduct of financial institutions. Beyond these social demographics, what else might the sector latch onto? So these are the things that really did have a positive bearing on or positively associated based on multivariate modeling, with more positive valuations. So it's having higher stocks of financial knowledge. So yes, financial education really does matter, particularly for the financial sector. The absence of financial strain, not having to battle with debt and credit commitments, and not experiencing debt anxiety, so the whole debt angle. Those receiving quality professional financial advice gave higher appraisals. Also trust, the trust factor. I trust financial sector reps, and that includes formal ones such as brokers and advisors, the banks as well as bankers, as well as more informally the Stokvels, the burial societies, and so on. Also, what mattered was having a sense of confidence about recourse-related behavior, being able to make active complaints in the case of a service or product that one's unhappy about. So promoting knowledge of recourse, where to go, what to do, is going to be crucial looking ahead. And we did find that the banked were far more positive than the unbanked, as well as those with no credit product. So not having credit products did seem to matter. So credit, debt, that whole tie-in. And lastly, those with a good sense of the financial products that services that they felt they needed, and also who have a tendency to thoroughly research their product choices, were more positive in their appraisal. So encouraging these kind of behaviors, competencies, and so on is going to be crucial for improving the outlook on the financial sector in the future. So the final theme is scamming. Are we a confident nation or not in relation to this? So just by entry point is looking at risky financial behavior. So before we look at profiling scamming, it's really important to understand the tendencies around, or the appetite for, risky behavior. And what we find is that people who are prone, or the general expectation is that people who are prone to risky financial behavior are more likely to become victims of scams. The survey showed between 1/4 and 2/5 of the public are prone to risky financial behavior, and that's what's shown in the bar chart. We can see that 37% on the left-hand side feel that risk-taking is an important part of their lives. 32% said they would take risks if they could make money quickly. 25% said they actually made risky financial decisions on a routine basis. And so what we've looked at also in the report and the different outputs is who is more prone to making these choices. We find male consumers are much more likely to take those kind of risks. Interestingly, the better educated are more risk takers, employed, and the non-poor. So obviously there's the availability of resources to take the risk. That's coming through these class-based effects. Then we asked about the frequency of attempted scams and the ability to recognize scams. So just under a tenth of South Africans said that they are often confronted with financial scams, which try to cheat them out of their money. But a large share, 57%, say rarely or never. In terms of their ability to recognize scams, only 20% were very confident in their ability to detect these scams. 39% were fairly confident, and 40% lacked any form of personal confidence in detecting scams. So clearly, this is an area where we need to focus a bit more. There's a particular age gradient underlying this, with older persons less confident in ability to detect scams and less likely to report scams happening. There's also a class gradient. So the poor and less educated are less confident to detect scams relative to the better educated and non-poor. And there was a strong spatial patterning too, with urban residents more confident than rural residents. So it gives you a sense of where to target information about scams and how to be a bit scam savvy. In terms of victimhood, 6% of South Africans report being a victim of scamming in the last 5 years. If we had to work out this in terms of numbers of people, this equates to approximately 2.6 million people aged 16 years and older. So quite a large number. And if we've looked at the confidence intervals there, so it ranges between 2 and 3.3 million. So a really large number of people report having been a victim. And maybe reality is much higher too. The types of scams, one is generic. They're quite generic, the descriptions people gave. They asked to say in their own words. 22% were very general, but they'd said that people took my money or it was cheating in general. Others referred to banking and particularly talked about having funds stolen from the bank, a bank-related scam, or having money withdrawn from the account. 12% referred to pyramid schemes, particularly. Others talked about SIM card and ATM-related scamming, airtime phones and data, scams involving job promises, issues around investment, insurance and loans, and there's a long tail on these indicators. This is the statistic Catherine mentioned early on. Only 39% were aware of what a pyramid scheme is, and it's one of the dominant forms of scamming that occur. We need to educate more around this. We find stark educational, age, and geographic variance underlying that, as that graph indicates. And that's really it in a nutshell, just to say that the purpose of these financial literacy surveys is really to provide the kind of evidence-based tool that government and other industry stakeholders can really routinely use to begin to monitor progress in levels of literacy in a fine-grained way, and thinking about interventions and targeted interventions that might need to occur. And our joint surveying results show that obviously the financial literacy scores for the most part have been quite stable with recent downturn. We also see that a fairly significant share of the country's adult population are still fairly ill prepared to make prudent financial choices and decisions. A lot of it is determined by limited resources and skills, and also that this has a tendency to render those segments of the public vulnerable to predatory lending, scams, and acquiring inappropriate products or services. Just to say, and this is something we'll probably return to, is there's a growing international emphasis on not just financial literacy, but financial capability. And really, what competencies must individuals have on what specifically do we need to inculcate in individuals? And what are the roles of institutions in trying to promote those competencies amongst the adult public? So I think on a policy level, what we've seen from the survey really reinforces and supports the emphasis of the National Consumer Financial Education Strategy of focusing on interventions to assist vulnerable groups, not in a static way, and recognizing it changes over time, and having really targeted interventions to meet that vulnerability, and that it will require a broad coalition of stakeholders across society to really promote greater financial well-being. So thank you. With that, back to you, David.
Dr. Roberts, thank you very much for that one. And I suppose a lot of information to take in. I mean, I've read the reports, I've read the briefing notes, and I'm still reeling with some of the things that are in there. So I'm going to invite the rest of the panel to also please join us. So if you can unmute yourselves or at least turn on your camera so I know that you're with us. And we'll give Dr. Roberts a chance to catch his breath after all of that talk, and perhaps give some of you else an opportunity to talk. So thank you very much for coming on. And as an opening remark for each of the panelists, I'm going to say, regarding the impact of this research on financial education, so we're particularly talking about financial education today, do we have enough information about consumer behavior to develop programs that are going to be effective? And Lindwell, I'm going to start with you, and then we can move on to Kulagani after that.
Thank you, David, and thank you, Ben, for that presentation. As David has said, the more and more I hear about it, the more I feel the less we know, as the song goes. So from an FSCA point of view, I think it's important. I think Kathleen has also mentioned that increasingly we embedding evidence-based and research-driven approaches to policy development, obviously, and supervisory and enforcement interventions. And of course, this includes financial education initiatives across the FSCA, because that's part of our mandate and the objectives of, as stated in the FSR Act. And it seems that consumer sentiment and inputs into legislative and regulatory frameworks, design and development has always been a little bit minimal. And I think through research such as this and gathering data on consumer needs, we then hope to bring forth and we hope to achieve our vision at the FSCA of fostering a fair, efficient and resilient financial system that supports inclusive and sustainable growth in South Africa. And this sounds obviously, because it's a vision, but this will mean nothing if we don't have these effective or develop effective financial education programs based on this data that we receive. Because I think in the conclusion, when Ben spoke about financial capability and financial literacy, if we don't know the levels of financial literacy and financial capability, and that particular stat that, 4 out of 10 people know what a pyramid scheme is, that's concerning and quite worrying. And it could mean that we're not doing our job effectively as consumer education activists, or that some people just don't want to know because it is a different way of making money, which is not within the regulated field. And if you get caught, those that started just move on to a different area. So yeah, for us, I think the data is very important in developing, obviously, new programs and targeted programs. I think Ben also spoke about targeted interventions, focusing on appropriate content for appropriate target groups.
Thank you, Lyndall. And let's hope people don't know what a pyramid scheme is because they've never actually been a victim of one. Let's try to put a positive spin on some of that. But yeah, it's a very good point. Kulikani from the Banking Association, any thoughts to add on to that?
Yeah, so thanks, David. I think it'll be difficult to argue that we know enough after the kind of research that was presented this afternoon. So clearly there are huge gaps in what we know about the consumers, and of course, financial institutions, banks, in my case, do not design products and programs blindly. They do draw from some kind of information, but that information is clearly limited, firstly. But secondly, I think it is also clear, both intuitively and from this research, that the sort of functional literacy levels of people play a huge role here. So we're talking here about just people being able to read and write text that they interact with in their general environment, being able to know, understand, and manipulate numbers in their environment. With higher levels of functional literacy and higher levels of education more generally, it's better to interact with those people. And I would argue that banks would have slightly more better information about those people to design programs and products. But clearly there are gaps that need to be filled. You are on mute.
Now I'm mute, yes. I realized first, so that's always good. Basil, do we have you online? And have you got anything to add from a National Treasury perspective for us?
Thanks, David. Yes, indeed, I do. Look, I think Dr. Roberts has provided some kind of the background to what I'm going to say, in the sense that he said it is evidence which us as policymakers and whoever plays a role in financial education, financial literacy environment has to use in order to close whatever gaps there are in the market. So it tells us what the needs are. So I think the policies and the education material that gets produced has to fill in that gap. And at some point in future, we have to assess how far we've gone. I think this is what a study like this does. So over time, it should be able to tell us where have we improved, where have we gone backwards in terms of filling in that gap. Thanks.
I'll get it right one day. Dr. Roberts, anything else to add from your side in terms of the knowledge gaps, in terms of developing financial education programs to help with this?
I just to reiterate what some of the other panelists have said, I think there can never be enough education. I think to deal with the kind of functional competencies that Kulakani has said and the kind of interventions that Basil and Lyndall have said. Just to say that, the challenges is it's not just about dealing with the knowledge gap that we're trying to address here, but there's also certain attitudinal behavioral aspects that are a little worrying. I didn't get to talk about them today. So we did mention the risk taking. We're risk taking, for a large share of the public, they are willing to engage in risk. The other thing is, and it's something that I'd advise people to look at the briefing report on it, is about material culture, materialism. And it's particularly quite strongly rooted amongst our youth. But what we find is that for those that have this materialist orientation, it's quite a significant proportion of the public, we find that's eroding involvement in money management. It's eroding budgeting in households. It's leading to lower caution in approaching one's personal finances, and it's diminishing a preference for saving because they want to also go and take the risk. And so I do worry about this sort of acquisitive culture, the need to the trappings of success and the need, and the materiality that's sort of crept hold in society. So it's not just about teaching people about being able to do the arithmetic or effectively, and be able to apply numbers. It's also about the culture of the money culture in society that we need to also interrogate. So that's the only thing I would add to what's already been said.
Thank you. So what I'm hearing is probably we need to look at consequences of decisions that you make. Buying that fancy pair of shoes now, what does that mean later on in the life? And it comes from that. And I think part of this, and Dr. Roberts, I'm going to look to you again, that, we're talking about financial skills, but we're also talking about personal skills. But it's very hard to do this at scale, particularly with some of the digital divide that we've been speaking about. So what are the key lessons that organizations who are involved in financial education can take from this, particularly looking at delivering from scale? And before you answer, I just want to say to our audience that if you do look at your screen, there is a questions and answers space there. So if you do have any thoughts or questions, please type them in there and we'll see if we can get to those too. But really, what lessons can we learn from a financial education viewpoint about delivering at scale?
Yeah, I mean, there's no magic answer, is there? I think, what we can see is really where the gaps are and that need to be addressed. We can see the vulnerabilities. I think we know from the various inputs we've had today that a lot is going on in financial education. There's a lot of activism, there's a lot of interventions. The question is it materializing? Is it translating? And sometimes we expect quick wins. We want to see it come through. We want to see big change in our financial literacy scores and unilinear improvements. And life doesn't work that way. And so often there's contextual influences that lead to unforeseen reversals, despite all the interventions. I think what we know from other types of, not just in the financial education space, but other forms of public education initiatives, that there needs to be a broad coalition of stakeholder organizations. It's coming together, trying to push certain common themes. Obviously, each organization will have its own sort of particular rollout of that, but making sure certain themes linked to those competencies, which we can see are lagging a bit, get emphasized. That does mean a degree of targeting and probably differentiated approaches to dealing with this. We can see that on different aspects, different elements of society are struggling. So it will need to be targeted and differentiated, as Lyndall's indicated. One of the tough ones is making it sufficiently localized. I often think back to the work that the ongoing efforts of the Electoral Commission, for instance, on its civic and democracy education, where they've actually got municipal outreach teams across the country on a continuous basis, trying to promote understanding of civic and democracy education broadly, but importantly the act of voting. So it's the kind of scale which is probably needed from the financial sector. Whether we're there yet is a question mark. Also, even if we look at other very successful campaigns over the last 2 or 3 decades, if you think back to the Love Life campaign, for instance, and the role of peer educators and so on, in terms of promoting at a localized level, attitudinal and behavior change. So we are a society where we've seen big successes in the face of enormous challenges. So it's something that can be achieved, but it is really an issue of continuous areas of reinforcement and broad coalitions of organizations.
Thank you very much. And that's a nice segue over to you, Lindwell. So the FSCA, obviously, as was mentioned, does have a mandate in terms of the Financial Sector Regulation Act with regards to providing financial education programs. So looking at the outcomes of the 2020 survey, what effect does this have and what implications does this have on the mandate for the FSCA?
Thanks, David. So I think I concur with Ben around the gaps, and with Khulekani that says, look, the data identifies the gaps for us. The demographics and the consumer profiles used in the survey is quite extensive, and you can actually pinpoint exactly where in the country the issues are and what the issues are. And in this way, obviously, we can now design activities that are more focused and reach the correct target audience, as we've said, because it seems to me sometimes we do a kind of a throw a stone in the bush approach, where we do an activity once off and we never go back to that target group again. So as we move towards, and I think Kathy mentioned this in the previous session as well, we're moving towards being a thought leader in the space. But for the FSCA, it will then now allow us to pilot particularly projects while still delivering on our mandate to promote financial literacy and implement financial education. But I think something that Ben has mentioned is quite important here is when we look at coordination and partnerships, because if you look at upscaling, I think there's a huge gap at the moment where partnerships and coalitions within the country is not so readily available for people to join in and upscale. And this is where I think coordination is quite important. And that is probably the role that the FSCA should be playing in the future by coordinating what is the various financial education activities. We know that National Treasury, and Basil might be able to speak more about that, they are developing a policy and a national strategy. But I think what needs to go along with that is a national implementation plan, an action plan, so that all stakeholders know exactly what it is that they do, because it is good to upscale and to form coalitions and partnerships, but it needs to be done within a coordinated way. And I think the regulatory mandate that we have that spills over to the consumer education, to the consumer education mandate, the more we can integrate that from an FSCA point of view, the more we can actually get to reach the consumer and look at consumer needs. I just wanted to mention one thing quickly, because we spoke about the actual social development and materialism, and Ben said about it being amongst the youth. We must never disregard the effect of peer pressure, not just amongst youth, but amongst adults as well. Because we live in a society where people are very close to one another, and people see what is happening within the community, they see what's happening to their friends. And the materialism, and I think this is where our fight really comes in as consumer activists. Do we compete with consumerism, or do we have the enough firepower to fight consumerism so that consumers can then make informed decisions going forward? So I just wanted to bring the social development aspect in as well, that we don't see financial education in isolation, but this is a broader social kind of process that you need to latch onto what kind of social programs is happening within the communities, and how can you actually latch onto that. But I'll speak more about that at a later stage. Thanks, David.
No, thanks, Linwell. Very good. And I think it would be remiss of me talking about collaboration and coordination, not to mention for those online that Money Smart Week South Africa is happening in August, and that's one way that we do collaborate and work on. So it's a good idea to go to the Money Smart Week South Africa website, mswsa.co.za, and look at that program, because that's one way we will all come together from a financial education viewpoint. So Basil, Linwell also mentioned National Treasury is developing a policy and a national strategy. I mean, we've had one in place, we're redeveloping and re-looking at it. So how does this research have an impact on the direction of that policy and strategy?
Thanks. I have to be excused. I've got a bit of a cough. So I think, like I mentioned earlier, I think the research identifies gaps that need to be filled. So I think what the new strategy is probably going to be different in is that it focuses a lot more on the recent developments in the financial sector. So we know that there's now a Twin Peaks way of monitoring well, there's a Conduct and Prudential Authority, the two twins that have been developed in order to monitor what's happening in the financial sector. The financial sector itself is very fast and dynamic, so there are changes that are happening every now and again in financial sector, in the financial products. So I think it also looks at the changes that are there in risks in products that are on offer. And I think it will also look at a strategy. So policy is one thing. It gives a direction of where we want to go. But then we have to develop a strategy as to how to get us there. I think the new strategy is going to have an accompanying strategy that will help us to take us to where we want to be. Thanks.
Okay, let me try that again. We've got the strategy, we've got the implementation plan, but you're also, as stakeholders in the financial sector, we've got an obligation with regards to financial education. So how do we fit as financial sector stakeholders into that whole plan, and what opportunities and obligations do we have with regards to financial education?
So who are you directing that question to, David?
Sorry, to yourself, Kulikani.
Okay, sorry, I didn't get that. David, I'll come to your question, but I'll answer my own first. And that is that, I mean, just thinking through the presentation that Benjamin presented earlier, two things are distinguishable, at least for me. One is the point he made about the impact of the sort of macroeconomic factors, poor economic performance, which has persisted throughout the period that's being measured here, leading to high levels of unemployment. So overlay that, so it puts stresses on people, overlay that with the sort of culture of materialism. So you still want to kind of attain certain things, acquire certain things. And so this is, I think, part of what accounts for the deterioration that we're seeing in the trends that Benjamin was presenting. So the second thing I wanted to just make a note of is that what is not visible here is, of course, the fact that also, through this period, you've had this explosion of social media and digital platforms that have allowed people to communicate directly. And so, Linwell and I, can run our financial education programs. They tend to be boring, right? Telling people about, you must have a budget and you must stick to your budget. When some people who they look up to because of the kind of orientation towards being materialistic, who live flashy lifestyles, who potentially also offer them information about how you can attain those lifestyles that they lead. Is, I think, some of the factors that are really, really working against us as various stakeholders who are trying to improve financial education in the country. So why am I going here? I do want to make the point that I think everything that's been said about collaboration, etc., and all the obligations that we have, but I think we've got to try, firstly, understand that we are competing with some of the people, the scamsters, and just everybody who promises quite a lot. They drive big cars, they wear nice clothes that the youngster wants to wear as well, etc., etc. And so, how do we design programs? How do we work together to counter those kinds of messages that are just everywhere? How do we make it less boring is, I think, a challenge that we have. So yes, obligations and the rules and everything, but I think part of what we need to understand is just make it funky, make it a lot more fun, and hopefully we can start to increase some of the scores that have taken a bit of a knock.
Yeah, thank you very much for that. And I think you're answering some of the questions that have been asked in the panel too in these. And yeah, I'm not too sure. Yeah, I got into financial services because my dancing wasn't very good. So I'm not too sure I'm the right candidate for TikTok and things. But it is a real issue looking at the social media and the proliferation on that and how do we combat that. I think one of the questions that have been asked here by Caroline De Silva too, and I'm going to paraphrase a bit, but we need to somehow neutralize the impact of economic pressure. So the question is, particularly looking at what happened over the last 2 years, I know what I need to do. I just don't have the income to do it. So how do we help people in that situation from a financial education viewpoint? And I'm going to open to the floor to see who wants to grab something like that. And if there's no one, I'm going to throw a dart and get someone. Basil.
Yeah, let me make a first attempt, but I'm not sure if it's directly answering your question. Look, I think since COVID, well, it started before COVID, but I think this thing became worse during COVID. So you had a period where some people were not working; they were not laid off, stayed on the employ of their companies, but were not being paid, not fully. Some were not paid 100% of their wages, so it was cut wages. And then they came to us and said, we want to have access to our retirement funds while we are in this situation. So I think what we are going to do, I think there's going to be a media announcement in the next few days. I think the media guys should look out for this, or I think even the financial industry. So what we're going to do is the contributions towards your retirement is going to be broken up into a savings pot and a pension pot. So I think that let me just leave it at that for now. So henceforth, I think when we contribute to our retirement, it's going to be broken up into those two pots. The thing is, with retirement funds, I think David will probably elaborate better than I can on this. People are forced by a condition of employment to contribute into a retirement fund. If it wasn't for that condition, they wouldn't have, because of inertia or other things. We said, no, it's something I look at when I get to my 40s or 50s and start thinking about retirement. But it's something that you need to start thinking about early enough, as soon as you start working. So what we're going to do is now force people to save so that they don't fall back onto taking all of their retirement savings whenever they reach a bad space in life. So we're closing that gap that Dr. Robert talked about an emergency fund. Thanks.
Thank you. And I think this highlights the fact that, I think it was 71% of people don't have access to an emergency fund of some sort. And that is a very worrying statistic, because it's showing the pressures that everyone is under. And then, yes, starting to use my retirement fund as an emergency fund is probably not the right thing to do. But, if I can't put food on my table, that's something that I need to do. We've also got a question from Francois Adrian, and this is quite an interesting one too. So we're talking about financial education, but should we be concerned in the long term about the levels of numeracy and literacy just in general? We can't be talking about financial education. So do we have some serious work? And again, it is a question, and any opinions on that matter? How do we raise general literacy and numeracy levels so that we can bring it into the financial education sector?
So let me attempt this one, David. So when I started off in my career, I was an activist in the sort of adult education space. So cared deeply about adult education matters, and at the time, this is sort of early 90s. We were concerned about the levels of literacy amongst adults, which were very high. There's a stat that was bandied about then, which was that 15 million of adults in South Africa were illiterate. And of course, many programs were designed to try and address that. I think, been out of adult literacy for some time now, but I know that there have been some improvements in that space. I think the bigger worry is the impact of poor schooling in those numbers. So early 90s, we were fighting adult literacy or lack thereof, but the schooling is not helping matters. So you've got people coming out of the school system that are really not functionally literate. So they can barely read, and there have been studies that show that kids at fairly high levels can't read for meaning, et cetera, et cetera. We've got to be concerned about that. And that's a point I was trying to make earlier when I said that, just functional literacy and functional numeracy is absolutely critical to the acquisition of literacy or financial literacy knowledge. Thank you.
Yeah, David, can I come in?
Yes,
as
please.
Well, just on both points. I mean, Caroline's points of removing economic pressure from measuring financial literacy, and the actual literacy issue, because if we look really at the two different economies we have in the country and the high Gini coefficient that we have, we find that on the lower end of the market that and to Kulkani's point, where learners have to sometimes leave school in order to support the family, which means the level of the education there is quite low. But it somehow also then seems to them to increase their financial literacy, because people then learn to cope. And that is why we sometimes have to look at informal ways of coping rather than the formal ways that people are coping. And it's an interesting question that Caroline poses, because if we take away the economic pressures and we talk about survival rather than economic pressure, it's a different matter than those that are in the higher end of the income bracket, because there it becomes a matter of, and especially, and here I'm talking about those above the middle, the missing middle that we call it, and especially those in the middle income groups who are at the moment quite battling to actually make ends meet. But those on the higher income group, it's almost like there is, some of these things don't concern them. And for me, sometimes the issue of greed comes in there. So here it is that we need to look at almost like two different centers of the economy, and then try and develop and design projects and programs, or even surveys that suit both of them. And maybe Ben can come in here in terms of differentiating. And we spoke about the generation gap as well, Ben, differentiating between those that have and those that have not. And who are more financially literate at the end of the day? Is it a coping mechanism, or is it just something that I have? So I'm not really worried about how much money I spend. So, I don't need the financial literacy that you're talking about. Thanks, David.
Yeah, just a couple of points based on Lindwall and Kulakani's inputs. I think, yes, I mean, the thing we need to remember is that levels of matric completion are a lot higher intergenerationally. But the question, as Kulakani posed, is what's the quality of that education that's coming out with, and what does it mean? I mean, the whole digital society, the move towards the digital society is going to produce more inequalities if we're not careful. So I'm worried about different types of competencies that need to be reinforced generationally as well, because I think it's all and well being functionally literate, and then there's digital literacy and digital inclusion as well as just general financial inclusion. So I think we need to constantly look at society in a differentiated way and understand across generations, across different spaces, what are the relative needs of the public or publics. And I think that is, I mean, it's the devil's in that detail, and I do worry about it, because I think it's something that is very difficult to have such a fine-grained approach relative to financial education resource constraints. So, I mean, I think our big hope is that schools, through various interventions, start performing better. I mean, the signs aren't good. I mean, the COVID disruption to schooling is something that we're going to live with for, I mean, there are estimates about effective numbers of education years lost. So is this the new lost generation that we might see, the COVID generation? And what does it mean as we move increasingly towards the digital society?
Thank you for that. And just in terms of respecting everyone's time, I think we could have this conversation and continue well into late night, but we are going to respect. So I'm going to ask that we wrap up, and it's a question that I'm going to ask each of you just to spend a minute giving thoughts to. Yeah, what could elevate financial education to take center stage as a priority area for consumers protection? So Basil, I'm going to start with you. Any thoughts on that?
Yeah, I think I thought you were giving us a minute to think.
A minute to talk.
Look, I think financial education, financial literacy should be everyone's business. It's not just governments, it's not just industries. I think people should also be, as individuals, concerned that they need to learn more because of the continuous changes in what is out there in the financial sector. So yeah, I think people have to develop that yearning for learning, and not learning from just one person or one institution. Just learn and compare. I mean, like you said, what Kulakani said, there's a lot of influence on social media. Some of these things in the social media are outrightly wrong. So we cannot be learning bad things from social media. We should be learning and comparing. Thanks.
Thank Kulakani, your final thoughts?
So thanks, David. Look, I think that firstly, the study is a very, very useful tool for those of us who are involved in financial education. It gives us very good pointers for what we need to do, areas of improvement. And my own view is that we could share a bit more as players and stakeholders in financial education. You know, some organizations have developed some really fantastic content. Just because we like putting our logos and things like the logo that's behind me, that kind of limits the extent to which Lindwall can take the content that we've developed and used it, because then he will be accused of promoting BASA and all of that stuff. So I think we need to find creative ways of sharing really good content to really support and advance financial education. Thanks, David.
Dr. Roberts, your final thoughts?
Yeah, just to re-emphasize a few of the points that have been said. I think financial education is increasingly taking center stage. How do we elevate it further? I think it is the evidence-based approach, the kind of industry players that are represented on the panel today, the FSCA, the Treasury, the Banking Association, are critical players alongside the other institutions such as your own, David. And I think it's that coordination that Lyndall was talking about is key. But I do agree with Basil's point. You know, there is an element of a individual responsibility in the mix as well. You know, that people must want to take this seriously. I mean, one of the key findings is that women do tend to take, for instance, a more fiscally prudent response to issues of increasing economic duress relative to men. Men are more risk takers and so on. So we are finding societal differentiation. So we might want, again, it's drumming home that targeting. Men need to be posed with critical messages about risk, about materialism. Women need to be talked about how to perhaps how to address financial inclusion amongst women. And the same applies to other different sectors. You know, we need that differentiation, recognizing, you know, that the approach we take must be founded on an understanding that people's financial education and exclusion are different for different segments of society. So understanding why that is, understanding what needs to be reinforced is the way forward on elevating the education focus.
Yeah, and then Lyndall, you can have the second to last comment.
Thanks, David, and I agree with all the previous speakers, and I think in a sense, Khulekani, what you're trying to say is we must start breaking the shackles. Sometimes we are so confined within our own organizations in terms of what we can and can't do that it makes the coordination quite difficult. And we're trying to say to each one another, but we need to support, we need to coordinate. But when it comes to certain aspects, and I must be careful also what I say, I hope my boss is not still on the line. But in any case, when it comes to certain situations, we sometimes feel that we are restrained and we can't do this and we can't do that. And once we have, and I think through National Treasury, once we have that policy, strategy and action plan in place, and provide the responsibility to everyone. And like Basil said, it starts with one person, but then it mushrooms further, because if we don't look at the individual, I think that the whole is then going to become rotten as well. Our challenge obviously is that the high rates of unemployment, the poverty that we have in the country, and until we address that from a social point of view, like Khulekani said, we can have the best financial education programs that we have, that anybody can bring. We can even make it sexy, like you said, we must do it. But people, if they're under financial constraint and under financial pressure, to talk to them about budgeting, to talk to them about savings, when they're battling to put bread on the table. So for me, it is not just a once-off thing. It's something that we need to coordinate from a social development, from a labor point of view, and from an educational point of view. And if those in command or those that are at the political level can just come together and put their heads together around that, I think it will spill further down. Or maybe it is that we should do this thing from the bottom up and start putting pressure from our side. Thanks, David.
So again, to the panel, thank you very much for your insights on this and making my job quite easy. And not running off on tangents. So thank you very much for that. I think, you know, what I'm hearing is there's a lot of work to be done from a financial education viewpoint if we want to move those indicators. But it is something that is not done by any one organization or any one entity. We should be working together. We should be pooling our resources and coming up with something more. But it's not just about the financial education side of things. There's societal pressures that we need to look at, and how do we achieve those societal pressures. And then it's not just about financial education is not something that we should be done to people, but should be done with people, because there is an element of personal responsibility. And again, I've seen some of the comments in terms of, should we use the retirement fund system? And yes, I think every interaction that we have with consumers as a financial services sector should be looked at it from a viewpoint of educational and not just running workshops, but every interaction, because we know that financial education works best when it's done on a just-in-time basis. So when it's done at the time when somebody's making a decision, it works very well. So we should include that in all our interactions. So again, thank you very much as a wrap up from the panel, and back over for the vote of thanks and everything like that. Thank you very much.
Thanks, David.
Thanks, David.
Thank you.
Thank you, David. Thank you, panelists. Careta, over to you.
Thank you, everybody. I've got hiccups, so please excuse me. Thank you, everybody, for joining this session. And we would love to have all your comments and include it into our Q&A for the session. So please do include that. And thank you for all our experts, David, Benjamin. I know Benjamin wasn't well. And then also Kulakani, Linwell, Basil, etc., for your views. And I think it's a very difficult, yeah, David, you're laughing. It's difficult. It's so yeah, it's difficult to actually, I think from my side, it's like I'm viewing the whole environment at the moment, and it's really difficult to see what people are doing and why people are doing it. And we need expert advice and motivation for people to do something different. And I think there's a lot of disinformation for them, so they're still continuing with a certain view, etc. So there's a lot of education that needs to be done. Thank you.
Thank you, ladies and gentlemen. I think that concludes our session for the day. Have a good day and a good evening further.
Thank you for everyone too.